Hey guys, Freaky Finance here. Last week we looked at Opera, and the week before that we looked at Canadian Dental. And both of those ideas, not only because they're cheap relative to long-term averages, but they also had favorable policies. And this video for Steel Dynamics follows a similar trend. This policy is more tariff related and more US onshoring related. This is my first time doing a steel company. I do own this one, I just started a position in it. Kind of rallied yesterday with everything else, but so it kind of sucks for the time of the video. But at the time I was flat. Basically, one of the screeners I was looking for, aside from favorable policies, is companies that both produce and sell their goods in the United States. Basically, what type of companies will benefit from tariffs on the domestic side in the US, as well as from more onshoring in general in the US, at least in the short term, right? And so this company came up, Steel Dynamics, largely US, right? In green here is there's three segments, we'll talk about them, but first one's the bulk of the business, probably 2/3 of the business. The next one's metal manufacturing, and then the last one, the smaller one, steel fabrication. How I work it in my head, I kind of like 2/3 of the business of this, 25% of this. So that's how I treat the two. There's some interesting growth drivers here we're going to talk about. So there's aluminum flat roll mill coming online in Columbus, Mississippi. There's also the new and growing production mill in Texas, in Sinton. Large focus in Indiana, US, very much an onshoring play as steel tariffs will affect competitor prices. So one of the other things before we jump into it, ferrous steel basically just means iron. So if you see the term in any other presentations, that's what it means. Basically it means that the metal recycling has a lot of iron in it, it's ferrous. Another advantage is exclusively EAF. So electronic arc furnace uses primarily recycled ferrous scrap metal to produce new steel. And this is very important to investment thesis, as well as the collection process and recycling, right? So they basically have a whole vertical integration here. Here's the slide. Yeah, this circle right here. This is probably one of the more important slides if you try to understand the business. So they have a recycling arm, which sells into their steel production mills. However, it also has the ability to sell out to other steel producers if it needs to. And this arm allows them to basically get utilization relatively high relative to its competitors because it always has a constant secure source of recycling going in. And so you're going to see that in the numbers, and the utilization is very strong relative to the industry averages for Steel Dynamics. It's operating well. Here's a way to just show that here. 91% versus industry average utilization rate of 76%. So and about 15% positive. Here's the breakdown just to show the size of the businesses, but also how they report them. So steel operations is the bulk of the business, 3.3 billion on the quarter versus 1.1 billion in metals recycling. You can also see it in terms of total assets, the lion's shares in steel operations, with aluminum operations just starting. So we've seen a lot of CapEx spend, and that's gone to aluminum operations, which is just starting to ramp up right now, which is another reason for doing the video today. Because basically they made a lot of money, we're going to go into it, but they made a lot of money in 21 and 22 when iron prices shot up and the recycled scrap spreads stayed relatively, I'd say, low. You basically, I would say, got outsized returns and outsized cash flow. And what they did with it was basically two-pronged. They invested a lot back in the business, so that's the Sinton, Texas mill, as well as this aluminum thing that's just starting up. And they've also bought back about 25% of the company in the last 5 years, maybe 26%. So they've done a lot of good things that I would have done over the last 5 years based on what they've got. So in terms of the three segments, just to go through them really quickly here. Steel operations we already talked about, 67% of the business. That's your flat roll group, your long products group, and your two main ones. In terms of metal recycling, you have the OmniSource here. So basically that's the recycler that can basically serve as a secure, high quality, low cost internal supplier for the SDI steel mills, which is great. And then if they have extra, they can sell to other users as well. Then you have the steel fabrications, which is small. Here to get an idea of what they sell, so what flat roll steel means, so hot roll, cold roll, coated sheets, galvanized and all that, painted. And then they have structural steel for long products. I kind of view this more as rail orientated for transportation. Then you have steel billets and loops on the semi-finished. On the fabrication side, you have the joist, decking, then metals recycling. We already talked about ferrous scrap versus non-ferrous, and then aluminum, which is just starting out. In terms of the tariffs, that's probably the most important thing. The benefits of the tariffs are not distributed evenly. It favors business models with like those of Steel Dynamics, basically because of the domestic electronic arc furnace using recycled scrap. It's perfectly positioned to thrive in a market created by this policy. This policy is nothing new. It's actually why the spreads were already improving the first time Trump was elected. And this protectionist mindset has helped domestic steel producers, especially ones that have the specific business model that Steel Dynamics has. One of the key things, because it uses this recycled metal that's already in North America, in the US, it insulates it from the raw material price volatility that might affect traditional blast furnaces, more dependent on imported iron ore. Right, so that's important to note. Here, now I am of the view, and I agree with the AI here, that basically the tariffs, in this case the steel tariff, is under the section of 232, and that's actually more likely to stay. Basically, here the AI says, likely be upheld due to the president and judicial deference to the executive on national security. So basically, you're allowed to do tariffs on specific industries at a specific time. All countries do that everywhere in the world. They're trying to protect a domestic industry. What you're likely not allowed to do is do tariffs on everybody everywhere all at once for everything. Basically, high likelihood of being struck down. So that's how I treat it. So some of the tariffs are likely to be revoked probably in the future. At least that's the AI thinks. Here's another way to show the nice utilization relative to the industry. Basically, consistently higher through cycle steel utilization because they have that vertical integration, the supply chain, when they own the recycler of the metal. Again, linking back to this good visual where the metal recycling is. Because they have that source and own it themselves. It feeds into that utilization better. Basically like a constant amount of feedstock. In terms of this is what I like to see. People are like, oh, it's declining now. And that's when I would actually start looking at a company like this because it's a price taker. So when times are good, that's usually when you're selling the security. And then when times are bad, basically it's time to start looking at it. And so it's been declining for the last 3 years into what I think is going to be a positive catalyst with the Trump tariffs that was kind of talked about. We're going to go to some reasons why, but on top of that, you also have the investments that they've done. They bought back 25% of the business. You have ramping in Texas and you have ramping in aluminum lines. So in terms of the ramping in Texas, here you can see they expanded their growth by 25%, basically with the new Texas steel mill, which is material. And then you have the new carbon recycled aluminum flat, which is also just started rolling in June 2025. An expected EBITDA 650 to 700 million. Through cycle consolidated annual EBITDA. So material EBITDA generator for the company as well. This is not a small plant in Columbus. This is probably, if you had to understand one core concept with the business, it'll be this right here, is the spread between average price for steel per ton and then the average ferrous scrap cost. So basically this is their input cost and this is their output. And now they're a price taker, but they have a little bit of control here. And what you're going to notice is that the tariffs, especially you can see in 2018, right? You used to have a spread of only $400 a ton. Now you have a spread of $900, right? And now it's come back down after. And you're also going to notice that the ASP, and the AI correctly referenced, often leads. So the average sales price leads, and then the cost of the input goes up after as well. So not only do you have a rate of change positive, which improves the margin that's at the time, you also have obviously a higher spread. That's what I like, and we're already seeing it come back down over the last 3 years. And according to the AI, and we'll fact check this at another point in time when I familiarize myself with the industry more, but basically they think every 4 years is kind of a cycle in steel. So it's a little bit quicker. And in terms of the share price, probably the weakness that I have with this idea, and the reason why it's not bigger, is because the share price hasn't come down at all. So usually what you see when you see declining fundamentals is the share price coming down, but it hasn't. It's kind of held in there. Part of it is because it's forward looking. Part of it is because they made a lot of good decisions with the cash they got. And a part of it was that the share price never actually went up as much as the business improvement did, which looks weird when I go back on a 5-year rate. You're up 300%. The business actually got better than that over the last 5 years because of the prices and the spread that they've been getting, right? Like you're literally making double what you used to the decade prior on the spread. And I think this policy, given what we're seeing, is likely to continue at least for the next 4 years. Here's the AI's reasoning. The spread between the cost of ferrous cap and selling price is also likely to improve under this tariff scenario. Steel Dynamics primarily utilizes electronic arc furnaces, which uses recycled scrap steel as their main raw material. This production method gives them a key advantage in a tariff-heavy environment. The tariffs primarily target finished steel products, not the raw scrap metal used to produce them. While scrap prices are subject to their own dynamics, they are not directly inflated by the 50% import tariff on finished steel. Therefore, as Steel Dynamics is able to command higher prices for its finished steel due to the tariffs is primary input cost does not necessarily experience a proportional increase. So basically, one artificially increases the ASP, tariffs, it doesn't necessarily increase the scrap. And if it does, it will do it at a lag. So the spread should continue to widen. At least that's what I'd argue. In terms of how it's balanced capital allocation, you can see $12.8 billion in cash flow from operations over the last 5 years. They put basically half back into their internal investments. So that's that steel mill in Texas and the aluminum. And then you also had share repurchases, and it does pay a dividend as well. In terms of the debt level, I'd say it's relatively low, 1.6 times adjusted EBITDA. So while there is debt on the balance sheet, which we'll see in a second, the EBITDA can easily handle it. And the maturity schedule is very nice, right? You only have $750 million the next 5 years. Relatively nice balance sheet, I'd say. In terms of the onshoring side, so when we have the tariff impact, which I think will help the margins, and then in terms of the demand side, you're going to have onshoring from construction. I should have mentioned this earlier, but basically the key industries that drive steel are construction, automakers, rail, energy. So there's quite a few, but those are the big ones to know about, especially construction. When you have a lot of people trying to onshore to avoid tariffs, or at least the risk of tariffs, they might put a plant here just for future risk mitigation. It also benefits steel dynamics because it helps the demand side of the equation. Here's the AI. Basically, I tried to make it forecast the steel price forecast for the next bit, because this will be a price taker. If steel goes down, investment's probably not going to linger around. Right. So anyway, most analysts point to 2025 as the year of continued price breaker, likely marking a bottom of the current price cycle. They think 2026 is going to be gradual recovery, and then 27 is the cyclical peak. So we'll see if that's true. In terms of the business, just to show you how much it's improved, you can see both what I like to look at the gross profit going from like 1.5 billion to 5.3 billion, so more than tripled. Boom to 6 billion, so 4 times it. Right, and now you can see it come back down, get halved, then halved. So now it's already in this mean reversion, which I would have preferred to see the overreaction in the share price, which we're not. And a part of that is because most people are probably looking at the forward-looking environment based on the Trump tariffs. You can see what they've done with the free cash flow, like we were talking about investing back in the business, but you can see the share count is going from 234 million shares to 155 million shares already, and it's dropping every quarter. So that's what I like. What stands out on the income statement, just really quick here, is you can see how little SGA is in the context of the overall company. And this is with spreads not as great as they were, right? With average sales prices going down year over year. You're seeing easy amount of SGA, and that's on a quarterly. Like here, if you look on a year, you can see, just imagine you're generating, I don't know, 4 times as much money, but you only had to put in $200 more million, right? So just imagine like going up by 4 billion, but only having to spend 200 million in SGA. So there's innate scale here on this SGA line as it relates to the scrap price spread between ASP and the ferrous recycled metal. We already talked about the balance sheet. It's relatively safe in my mind. I've seen better, I've seen worse. I think because of the EBIT generation, it's easily held, and because of the maturity schedule is well staggered, I think it's easily held. You can see one of the funny things here is that the treasury stock is one of the biggest items on the balance sheet. It's almost as big as their PPE, which I thought was interesting because it is a CapEx, I'd say, heavier model than what we've used to talking on the channel. But you can see the treasury stock is 7.5. They've already bought back 7.5 billion of themselves, right? So that's material value here, and a decent amount of cash flow. However, you can see in these are 6 month snapshots over the last 2 years, you can see CapEx actually been relatively high, actually higher than the CFO. So they've already been in investment period for the last 2 years, and we're just coming out to see the return of that right now as well. So you have a lot of catalysts for growth for this company all at once. And the only weakness is that the share price hasn't gone down into the declining current fundamentals, which is what I like to hope for when I see the steel prices come back down like they have for the last 2 years, right? It's not like things were great for the last 3 years, but the share price held in, at least in terms of rate of change, which I'm used to seeing a response to. And then to end off, just to be, I asked the AI basically to forecast not only what their ASP would be, but what the scrap would be and what the implied spread would be because of that. And so the AI thinks the spread reflects the trough in 2025. Scrap cost decline is sharper due to weak industrial demand and bearish market sentiment. Now they think the recovery is going to begin in 26, and then they're going to think cyclical peaking again on the demand side. Now, I think this is going to happen partially just because of the tariffs are going to put a floor on the ASP. So you're likely to see some appreciation on the ESP side just from the tariffs. And then this, I think, is going to be stickier than normal as well. So you're going to see a little bit more increased spread. In terms of the PE, you can see, I mean, it's 13.7 right now implied for the 2025 year. You can see material growth. These are analyst expectations, so it kind of tells you why you're not getting a decent price. As a lot of people are expecting earnings to go up 37% year over year, right, in 26. So you're seeing it already at 10 times earnings, which is pretty nice. And this is one of the reasons why, when it got so much cash flow, it was able to buy back so much of itself. Because the valuations for this type of companies aren't that expensive, because they are price takers at the end of the day. However, at this current point in time, this company, based on the current policies and its own investments and where it is in electronic arc, and that it owned its own recycler, it has a lot of things that are very special at the specific point in time. So anyway, I'd like to know your thoughts on steel dynamics. I'm going to have some more fun. I think I'm going to familiarize myself a bit more with the steel industry. It was kind of fun to try to piecemeal what's important, what's not, and try to put it in a video in under 30 minutes. But yeah, anyway, have a great rest of your week.